Hi everyone, Kathleen here. I'm the Research Director at XTB. It's a busy week packed with economic data, central bank decisions, and even a National People's Congress in China. The rally in stock markets has paused after some stock markets reached fresh record highs at the end of last week. Nikkei in Japan broke above the key 40,000 level at the start of this week, and the German DAX also reached a record. When stocks break these key thresholds, they can wait for the next driver before moving either higher or selling off. This week could provide plenty of drivers. First up, we have the Federal Reserve's Chair Powell. He testifies to the US Congress twice this week. He's likely to say that inflation pressures remain and that the Fed may not cut interest rates that quickly. Right now, the market expects the first rate cut in June, and there are just under 90 basis points of cuts priced in by the market for this year. If the Fed chair says something this week that could put the number of cuts in jeopardy, then we may see the market react. Back in December, when the Fed signaled that they would be up for rate cuts in 2024, we saw a massive rally in stocks. So if the Fed reverses course on this, it might cause stocks to sell off. Now, if there is a sell-off, which markets could be most at risk? In the US, the tech sector, particularly the semiconductor industry that's powering AI, is the top performing sector. However, the rally has been broader based than some expected. Consumer discretionary stocks have also had a good run this year. We think that these stocks could be more at risk, as higher for longer interest rates could hurt the consumer. In contrast, the tech giants, for example Nvidia, Microsoft and Meta, have the financial muscle to probably weather any stock sell-off quite well. If Chair Powell's comments spark a broader risk sell-off, then European stocks could also come under pressure in the coming days. Now, the US economy is doing well and there are signs that inflation pressures are building once again. However, we have to wait for Friday before we get the latest data on the US labour market and the infamous non-farm payrolls report. Economists currently expect 200,000 jobs to be created in the US last month, and wage growth is also expected to slow. If this is true, then it may calm any sell-off at the end of this week. Now, we're also watching the ECB meeting on Thursday. President Lagarde may also sound cautious on the prospect of a June rate hike. Since wage data remains strong, the ECB might need more evidence of inflation pressure receding before they cut rates. Now, Q1 has been positive for stock markets so far. The S&P 500 has risen by more than 7%, the Nikkei is up 12%, and the Euro Stoxx index is higher by nearly 7%. But can those gains continue for the remaining weeks in Q1 if interest rate cuts are pushed back to the second half of this year? This could be the dilemma facing markets this week. That's it for now. See you next time.